Welcome back to Investing Talk Podcast. Today we're tackling a question many of you have asked. Is Lucid Group a good time to buy now? We've compiled your sources on recent structural changes, profitability struggles, and, well, the huge speculative upside surrounding this luxury EV maker. If you find this conversation useful, please remember to subscribe, like, and comment below. And definitely let us know if you want us to look into a specific company next. Just leave that request in the comments.
Yeah, Lucid Group is still one of the most compelling stories out there, but also incredibly volatile, right? Especially in the luxury EV market. The analysis we've gathered really paints a complex picture. You've got this rapid revenue growth, which looks great on the surface, but then juxtaposed with these massive operational losses, and it's all underpinned by this strategic backing that makes it, well, quite different from most of its peers. So we'll look at what's happened over the last 3 months or so, try to make sense of why the numbers seem so contradictory, and what investors really need to be watching going forward.
Okay, let's unpack that recent history first. Thinking about, say, August through October 2025, the stock's clearly been under a lot of pressure. Those Q2 results back in August, how much of a shock were they, really?
They were pretty significant. The Q2 earnings miss, that really set the tone for the volatility that came after. Lucid reported a negative EPS. Let me see. Yeah, $2.80.
Yeah.
That was much worse than the consensus, which was expecting something closer to $2.20.
That's a big miss on the loss per share.
It is a substantial deviation.
But wait, if the loss was that bad, what about their actual operations? Did revenue drop too? Or is this one of those cases where they're growing, just unprofitably?
That's exactly the conflict here. That's the core issue. Despite that huge loss, revenue actually climbed. It was up 29.3% year over year.
Yeah.
So you're right. They are succeeding in growing demand, getting into that luxury space, but they're doing it with deeply negative margins.
Right. So the delivery numbers fuel the bulls, but the losses fuel the bears.
Precisely. That success in deliveries keeps the long-term story alive, but the negative margins just amplify all the concerns about cash burn and, when or if they'll ever be profitable.
And because the share price was suffering, management then made that move. The structural change, the reverse stock split in September.
Yep, the 1-for-10 reverse split.
It sounds like standard financial plumbing maybe, but what was the real aim? What were they trying to achieve for the average investor looking at the stock?
Well, it was almost entirely about the optics,
the
look of the share price. Plus, there was the practical need to maintain Nasdaq U compliance, staying above that minimum price threshold.
Yeah.
So enacting that 1-for-10 split on September 2nd, it did shrink the share count. It did raise the nominal price. But crucially, it didn't do anything to solve the underlying problem. The cash flow issues, the massive losses, and that disconnect, the improved optics versus the unchanged, difficult financials. That's exactly why volatility actually increased right after the split.
Interesting. And even with the split, and didn't they also unveil a new version of their electric SUV around September?
They did, yeah. Trying to keep the product momentum going.
And despite all that, analyst ratings stayed pretty lukewarm, right? Mostly hold through October.
Generally hold, yes. What's really telling, though, is the range in their price targets. It was just huge.
How wide are we talking?
We saw targets from as low as, I think, $2.10 all the way up to $30.
Wow, $2.10 and $30. That's basically saying nobody really knows.
Exactly. When analysts disagree by that much, by a factor of nearly 15x, it signals intense uncertainty. Uncertainty about the cost curve, about scaling production, and ultimately about long-term survival if these losses keep piling up. It's a speculation engine.
Okay, so let's pivot from that market sentiment, that uncertainty, to the fundamentals, the core numbers. We keep coming back to this clash. Operational growth versus financial distress. What specific data points really highlight the growth side of the story?
The growth narrative, on its own, that's pretty strong. Revenue growth actually accelerated to 35.71% in 2024 overall. And perhaps more importantly for the manufacturing story, those Q2 2025 vehicle deliveries jumped 38.2% year over year.
How many cars was that?
Those 3,863 EVs delivered in the quarter. So they are scaling up, they are getting cars built and delivered.
But then we hit that profitability wall again, hard.
Absolutely brutal, yes. The net loss in Q2 was $539.4 million. And to put that into perspective, that operational benchmark figure is just shocking. As of Q2 2025, reports suggest Lucid is still losing roughly $300,000 for every single vehicle they sell.
$300,000 per car?
Yeah.
That level of cash burn is Well, it's almost hard to comprehend. You're basically giving away several luxury cars for free with every one you sell. If that number doesn't shrink dramatically and soon, how are they even surviving? Why aren't we talking about imminent bankruptcy like with some other EV startup?
One reason is a huge one: liquidity and backing.
Ah, the Saudi connection.
Exactly. Lucid has, or had as of the last reporting, $4.86 billion in total liquidity, cash and available credit. And this substantial reserve is very heavily supported by the Saudi Sovereign Wealth Fund, your third investment company.
Right.
This unique backing provides a much, much longer runway for R&D, for building factories, for just funding day-to-day operations than almost any other startup could dream of. So that liquidity, that backing, it fundamentally changes the near-term risk. It pushes back that solvency threat that would likely have crushed another company burning cash at this rate.
Okay, so the Saudi cash buffer removes the immediate solvency risk, but the company is still bleeding money. What are the next potential turning points, catalysts that could shift the narrative over, say, the next 3 months? What known events could move the stock?
The most immediate and probably the most critical event is the Q3 earnings release. That's scheduled for November 5th, 2025. That's going to be the big one. Investors, analysts, everyone will be scrutinizing it. They won't just look at deliveries.
They'll be looking for margin improvement. Any sign that the $300 K loss per car is coming down?
Precisely. Any sign of improvement in margin trends. If that loss per vehicle starts showing any significant downward trajectory, even if it's still high, that could trigger a positive shift in sentiment. That's the number one focus.
And then later in the quarter, we also have those more technical market events, right? Index rebalancing, institutional disclosures.
That's right. Towards year end, you've got the quarterly ETF rebalancing around December 15th, and then institutional holdings disclosures around December 20th. These are important because they give us a sense of how the big money, the funds, are positioning themselves after that reverse split. Are they buying, selling, holding? Index changes and big institutional moves can definitely add to the volatility, especially now the float is technically smaller.
Makes sense. And looking at the stock chart itself, the technical picture, has the price found some kind of floor after the split? Is it stabilizing?
Technically, the picture actually looks somewhat constructive right now, suggesting maybe a bullish phase recently. The stock's been consolidating, trading mostly in a range between $19.60 and $21 lately. But here's the key technical signal. It's trading comfortably above both its 50-day moving average, which is down around $14.72, and crucially, way above its 200-day average, which is still lagging way back at $5.58.
So trading near $20 on the long-term trend indicator is still below $6. That implies a pretty sharp recent upward move.
Exactly. It shows a dramatic recent bullish repricing. Technical traders definitely pay attention to that kind of divergence. Yep. And based on that, some technical forecasts are projecting a potential short-term trading range, maybe reaching up towards $25.21.
Okay, $25. Now, let's get into the really speculative stuff. The high-risk, high-reward chatter that must be driving the top end of those analyst targets, like that $30 figure. What are the big rumors, the potential game changers that investors are watching, the things that could deliver a massive step change in valuation, even if they're just rumors for now?
Right. This gets into potential strategic actions, especially given, as we discussed, the deep involvement of their main backer. There are really three key rumors or areas of speculation fueling that bullish sentiment. First, there's persistent chatter that our third investment company, the Saudi fund, could either increase its already a substantial stake or potentially consider a full buyout.
A full Saudi buyout. That would obviously remove all the funding uncertainty overnight, wouldn't it? Provide total stability.
Completely. Total game changer for the balance sheet risk. Okay, second rumor. Speculation about a major OEM partnership.
Like teaming up with a legacy automaker.
Exactly. An alliance with a big established manufacturer, maybe for sharing EV platform development. Lucid undeniably has cutting-edge technology, particularly in powertrain efficiency and battery tech. If they could license that or co-develop with a major player who needs to accelerate their own high-end EV plans, that could unlock huge efficiencies, scale, and revenue streams.
Makes sense. And the third one usually involves future tech.
You guessed it. That's the speculation around some kind of new autonomous driving breakthrough, or maybe a significant robo-taxi initiative or partnership. If Lucid could demonstrate a credible path in autonomous driving, something competitive with what Tesla, Waymo, and others are doing, that would be a massive potential upside lever. It taps into that whole future mobility narrative, though it's probably the most speculative of the three.
Okay, so let's try and pull all this together. It's a lot of conflicting signals. We've got impressive growth, leading tech, but also these monumental losses, and this heavy reliance on one major strategic investor. How does this all distill down into an investment thesis right now?
Well, complex is definitely the word. The investment thesis is anything but simple. You have strong operational momentum in deliveries, you have what many consider market-leading technology, especially in efficiency, and you have that vital, substantial liquidity buffer thanks to the Saudis. You put those together, and that's what leads analysts, on average, to that 12-month price target around $28.38, which, from current levels around $20, implies a pretty hefty potential upside, what, 44.6%?
Yeah, quite significant upside implied there. But the flip side is just as stark, isn't it? The reality of those negative margins, losing $300 per car, and the absolutely fierce competition.
Fierce is right. You've got Tesla dominating. You've got the legacy automakers like Mercedes, BMW, Porsche, all pushing hard into luxury EVs, now with deep pockets and established brands.
So, who is this stock actually for?
Precisely. Based on all this, the stock is fundamentally seen as attractive mostly for two groups. First, high-conviction, long-term investors who are banking on management executing on potential strategic alliances or that buyout materializing on global expansion, and crucially on eventually fixing those margins. And second, it's attractive for short-term traders who are playing the news flow, the technical signals, or those rumored rallies.
And who is it not for?
It is explicitly not suitable for risk-averse investors. The level of cash burn, the reliance on external strategic capital, the sheer uncertainty around profitability. It's just too high risk for many portfolios.
We've certainly covered a lot of ground there, really focusing on this strange dynamic of strong delivery growth happening alongside enormous financial losses, and how that sovereign backing just completely changes the usual risk calculations for survival. It makes it a viable, if very high-risk, equity story.
It really does. And maybe here's a final provocative thought for you, for our listeners to consider. We know the stock is highly reliant on its sovereign backing. So if those rumors we talked about, particularly the one about a potential full buyout by the Saudi partner, if that were to actually materialize, how much of a discount might the current stock price be reflecting? Considering that its massive operational losses today could be masking the true underlying value of its technology and its production capacity, value that a buyer might be willing to pay for. Something to think about.